So we've got pensions as well.
Okay, yeah.
Not very sexy,
No.
but very tax efficient. Still very tax efficient. I know they've popped up in the budget, but this is your company paying into your personal pension. The company, your company, gets a tax deduction on that. It sits as a cost in your profit and loss, and there's no tax charge on you in that pension.
Cool.
So that's a great way to get good money out. So typically,
Is that 100% deductible? So if you put so you put 30 grand as your pension from your business can pay it straight in, yeah.
So
you pay it straight in, 30k. That comes off your profit and loss account straight away. That's paid into your pension. So you're basically, it's depending on what tax rate you're paying, whether it's 19 or 25% before tax, you're saving that.
Correct.
On your bill anyway.
Yeah.
You're not paying it personally, so you're not having to take a dividend.
Correct.
Pension.
Correct. Yeah.
So that's a really good tax deduction essentially as well. Welcome back to the channel, everyone. It's Alan here. And today we've got a very, very special guest. If you want to be able to master your business finances in any capacity and personal finances for that matter, you're going to want to listen to this today. If you're struggling, if you don't know how to manage your VAT, your taxes, and you feel at the end of the year you've made a profit, but maybe you haven't in your own head, I don't know. I've got Karl here today from GMR Accountants who will help you master your business finances. So Karl, welcome to the channel.
Thanks, Alan. Made up to be here. Looking forward to this.
No problem at all. Well, really looking forward to have you. The reason this all started, to be honest with you guys, was Karl does some really good LinkedIn posts, and I'll link to that in the show notes as well. And he goes on about mastering business finances in some scenarios, which we will probably cover today. But I suppose before we get into that, could you just give us a quick background on your journey and what inspired you to help business owners master their finances?
Sure. I'll try not to go back too far.
Go as far as you want.
So, after getting drunk in college and university, I kind of looked around and thought, what do I like doing? And finances popped up. I seem to be the only one in the kind of college classes that like the finance type stuff. Yeah. So I applied to lots of roles, got nowhere, but someone took a pity on me and gave me a summer job, and it kind of went from there. So I got my first accountancy job in that summer. Yeah. And then I trained to be an accountant, qualified, went to a couple of places, and then in 2006 it was, went to where I am now as an employee. And that business was set up by two chaps in 1981, which is the year I was born. And they kind of wanted to keep the business going. So I was pinned as the future, as it were. Yeah. So 2012, they offered me a partnership. Yeah. I bought into the business, and then 2 became 3. And then at that point, it was a case of, oh dear, I was an accountant, and now I'm a business owner. And from that point, things completely changed for me. Yeah, I can imagine. It was no longer about preparing accounts and tax returns. It was about really helping clients. So I've been doing that ever since, working with my own clients, helping them, the phrase, master their company finances. Yeah. And just helping people get a better understanding of what's going on in their business, using the numbers to show them the story of their business ultimately. Cool.
And so this journey that you've got on, obviously to help business owners master their finances, I suppose where it probably started from me when I first engaged with you was you had a book, is it The Profit Compass?
Yes, yeah.
Yeah. So that's probably where it started from. I mean, it's a shameless plug for Karl's book here if you want to go on Amazon. Is it on Amazon?
It's not on Amazon, no. It was meant to be a little PDF that got a little bit bigger. But I can send somebody a copy if they want to.
We can put a link in the show notes for you. Yeah. So I suppose this journey started from there. So do you want to just explain that book a little bit, and then what we'll do is we'll go on to the business and finance post.
Sure. The Profit Compass, as I say, it was kind of, I was getting into the marketing side of things, trying to attract the type of clients that I like to work with, where I could get a bit more involved. Yeah. So I thought I'll create a little ebook, and it got a little bit bigger and became I still don't call it a proper book, Alan. It's 88 pages, but it's condensed and it's good knowledge in there, and it's basically around some of the work I was doing with my clients at the time, and how we're using their numbers to help improve their businesses. Yeah. So that was I wrote it in a week. Just kind of sit down and thought I'll do a book, and in a week I got it pretty much done, got it out there, and it's been seen by thousands of people now. Yeah. I almost forget I did it, and I think that was back in 2016, 17, something like that. So I almost forget it's there.
But I think that's what, I mean, listen, I'm just making an assumption here, but I think that's what's probably kicked off this journey to where you are today.
Yeah, you're probably right.
What you're trying to achieve. Obviously, if you look at Karl's LinkedIn, which again I can link to in the show notes, it says you're a forward-thinking accountant, which I think is quite key because, and I'm not knocking most accountants, but most accountants in general are quite reactionary, which I'm sure you'd agree with,
Yes.
which can work, don't get me wrong, but I think being forward-thinking with the business finance posts that you do, and obviously the book's really, really good. But I mean, you often share relatable posts around sort of business and personal expenses. So what financial habits should a business owner start from if you're starting their journey? So what should they focus on? And what are the problems that you see as well in terms of, obviously you do a few posts about a business making profit, but what should the business owner focus on from day one if they're starting today?
Sure. I'll let you know that I work mainly with limited companies.
Okay, yeah.
Okay.
Fine.
So the biggest thing between business and personal expenses is don't mix the two.
Yeah.
Okay. That's the most common problem that I see.
Yeah.
It's your business. You should reap the rewards, but that doesn't mean that you should just use it as a cash machine. So you've got to treat your particular limited company separate. It's a completely separate entity, a separate vehicle that's there to give you that personal income.
Yeah.
And rather than just putting every single expense through that limited company, you should try and get the mentality to go, well, that's over there. I've got my business expenses over there.
Yeah.
After the revenue less the expenses gives me the profit, I can then take the profit. And just having that mentality to separate the two is a big shift. And I think it's something that a lot of startups struggle with.
Yeah.
And it all ends up in one big messy pot. And you just can't see the woods for the trees.
Yeah.
It's all mingled into one. And it's really difficult to see where you're going and how the business is actually performing, because every expense, business and personal, is all mixed into one, and it makes it really difficult to see.
So what are the common mistakes that you see from business owners with that? For example, obviously, I've always been quite disciplined on that front. I've always known what's tax deductible, but also known where you can't use it as a cash machine. I'll be honest with you, once upon a time, I think I was out on a night out a good few years ago now, and I think I did use my business debit card as a cash machine. I didn't realise, but again,
you naughty boy.
I know. Hope HMRC aren't watching. I'll be in big trouble taking that 200 quid out. But what are sort of, again, I'm sure there's a lot of different examples, but what have you seen? Obviously, you do a lot of this on your LinkedIn posts, which obviously everyone can have a look at, but what's the most common theme, what people do?
I think, to sum it up, it is American Express. Okay.
Right, okay.
Because you get great benefits with American Express and
yeah.
cards like that. You get your flights, etc. So, that can be a business card.
Yeah.
But then because you're getting these points through it, the temptation is to load as much as possible through the American Express card.
Yeah.
So that's fine. So if you've got the company card and let's say the company pays that by direct debit each month, that's fine. But if there's a mixture of personal and business expenses in there, in your accounting software, you've got to separate the two.
Right.
So I see that quite a bit. It starts off small and then gets bigger and bigger and bigger. So it's the nights out, it's the meals out, it's the clothing, it's everything you can think of goes on that American Express card, and it's covered by the company.
The business American Express card.
Yes, but
they're buying their their Dolce & Gabbana suits for example.
That's it. Everything's going through that, and they kind of know that. This is personal, but I'll get the points because it's going for the business card. But that's where things can get a little bit messy because, if you simplify things and go, well, this is my personal stuff over here, and this is my business stuff. You can see the business profits that's left, and then you can draw that from the company to pay for your personal stuff. But if it's all just messed into one, you kind of forget about it. That night out you've had, you've forgotten about that, and then you go, well, I'll take my normal £3,000 this month. Well, it's £3,000 plus the personal expenditure.
Yeah.
That is your dividend, your personal income. And that's where a lot of business owners get tripped up, and that can result in some nasty kind of tax bills further down the line.
Yeah, I mean, I think one thing I'd suggest, I'm sure you're going to agree with me here, because we spoke about this in the past, is, and I adopted this a good few years ago now, was just getting management accounts done each month.
Yeah.
Because I think that eliminates, because I think if you've got a lot of clients who are doing that, and then they come end of year with all the receipts, and you're going to go, well, we can't take that off. Actually, your profit's this, and also you got to pay this back into your company because it's on a direct loan account. Yeah. I think if you get management accounts done monthly as a business, you're going to go, don't get me wrong, it's going to cost you a little bit more money, but you're going to get rid of that monthly, and then you're going to know.
Absolutely.
So I suppose one thing I've learned as a business owner is and I've adopted it across all the business I'm involved in, is just have management accounts ready, because you can review them, see how profitable you are, make sure them deductions, that can't be, that can't be taken off, your end of year tax bill. You're going to know in that month.
Exactly.
And I think that gets rid of the problem where you've got a big end of year tax bill. So I don't know, I'm sure you would agree with that
100%.
as an accountant by trade, but I think management accounts are absolutely key for any business.
100%. And I think there's a mindset shift before that.
Yeah.
Because I think a lot of people view their accountant as a cost.
Yeah.
You've got to have those year-end accounts and you've got to do the tax return. So the temptation is to get that done as cheaply as possible.
Yeah.
And then the accountant will mop it all up at the end of the year. But as you say, you're going to end up with surprises. You don't want the accountant delivering a tax bill to you a day before it's due.
Yeah.
And it's 10 times higher than you ever thought it would be.
Yeah.
You want to know in month 2, I can't claim that. That's going to sit over here. And this are the tax implications.
Yeah.
You're well ahead of the game, more than 12 months ahead of the game.
And I think one thing as well to give you a little bit of a boost here is I noticed from just doing management accounts, with multiple accountants now, that I think your business becomes more profitable overnight because you realise where you can cut the fat, you realise where your sales need to be. But one thing that I think I've spoke to you about in the past on the phone, or I can't remember where it was, is I think you help your clients build like a sales forecast potentially with depending on what depending on how much help they want, you can actually tell them how much they need in terms of sales to meet their sort of net profit before tax obligations, if that makes sense.
Absolutely, yeah. I mean, I like to work backwards.
Yeah, that's what I meant.
So most people would start with a forecast and the top line would be sales. You can't take sales home. The sales, they've got to be big enough to cover all the costs, and then you get the leftovers. My advice is to start with the leftovers. What do you want to draw from your business? Therefore, what profit do you need? What will your expenses be? And work your way up to the sales.
Yeah.
And doing it that way just gives you much more clarity rather than let's hit £1 million sales this year. Because you're going for the wrong target. It's not the £1 million sales you want. It's the £200,000 net profit you want.
Yeah.
If you just hunt for the sales, it's easy to get a sale if you offer someone a 50% discount, but you'll end up with no money left over.
Yeah. I mean, a very intelligent FD, Richard Worrell, if you're watching, hello, he said to me once, turnover is vanity, profit sanity, and cash is reality. Yeah. Because if you've got no cash in your business, obviously, you can be profitable, but
absolutely,
you might have a big debtor book and you're not be able to collect the cash and you're going to go out of business. So when I took that, I probably got told that about 10 or 15 years, probably about 10 years ago now, and that phrase has just stuck with me forever.
It's like a little light bulb that goes off, and you just kind of. But it's also that links back to those management accounts, because we're not just talking a profit and loss. You've got a balance sheet in there and a cash flow, and at the end of and they're all different. Yeah. And as a business owner, it's your responsibility, I guess, to learn to understand and read that, because that's telling you where your business is at, where it's been, and then you can look at where it's going to go. Yeah. And going back to your point before about the management accounts, the simple phrase I like to use is what gets measured gets improved. Yeah. So if you're measuring and monitoring something, then you're naturally going to want to beat it and improve it. Yeah. If you only look at those figures once a year when your accountant delivers the tax return, you're not going to make those improvements. Yeah. And especially when they're just small incremental improvements every single month. Yeah. They can add up to a huge amount of extra profit for you. Yeah. No, absolutely. I couldn't agree more. Just one more thing on the business finances, because I think mastering your business finances is really key. But ultimately, I always think any business that you own, unless it's a business where you're reinvesting all the money back in, and you're trying to build a big product to have a big sale in the future. But I'd say the majority of people watching this, the majority of your clients are probably people who create a business to give them a better lifestyle and also draw profits from it. So what is the most common financial mistake that you see business owners make in terms of taking money? And again, I know you can't give specific advice to people, whoever's watching this, because you need to understand everyone's situation. So if you want advice, speak to this guy. But what is the most common financial sort of tax mistakes? Obviously, you've got let's just assume that you've mastered your business finances. That's all good. What are the most common mistakes that you see when people draw in from their businesses in the UK? Simply, it's forgetting about the tax or not planning for the tax. Yeah. So as a limited company business, your corporation tax bill is due to be paid 9 months after your financial year end. Yeah. So if you've got a year end, let's make it simple, January to the end of December, your corporation tax bill is not payable to the next 30th of September. Yeah. So as a business owner, you'll think, okay, I know that's coming, but I don't have to deal with that right now. And you'll see the money in your bank account, and potentially you'll take that money in your bank account. And that's the biggest mistake I see people making, because what happens is at the end of December, the business owner gives those financial statements to the accountant, says, do your stuff. The accountant prepares the accounts, prepares the tax bill, and says to the client, here's your tax bill. And what often comes with that is also, here's an overdrawn director's loan account.
Yeah.
And you've potentially got more tax to pay on this. And that's because you've taken money that wasn't yours. And then the business owner's response is, well, it was there. It's my business. I can take it. Your dividends as a business owner are only payable to you with profits after tax.
Yeah.
As a business owner, chances are you don't know what that tax is as you're running through the year. So you should therefore estimate what those taxes are going to be each and every month. So by doing that, and you'd show that in your management accounts,
of course, yeah.
Here's the profit that we've made, here's the tax provision on those profits for that month.
Yeah.
Therefore, we should really park that money aside.
Yeah.
If you do that, you're going to be so far ahead of the game. You're going to have a separate tax pot, money, physical money, building up each and every month. By the time that tax payment is due, you're going to have more than enough. If you've been saving from January all the way to December,
Yeah.
you'll have all that money 9 months before it's even due.
Yeah.
So you can actually be earning interest on that money.
Yeah.
The opposite is that all that money is taken by the director. The nasty accountant says, here's your tax bill, and you owe your company money back. If you can't pay your company money back, it's going to pay tax at 33.75%.
Yeah, the business will. And obviously, from what I'm led to believe as well, even if you do pay that back, I believe getting the money back from HMRC in that situation can be quite hard as well, and arduous for accountants.
It's, I'm trying not to swear here, Alan.
Yeah,
it's a pain in the backside.
Yeah,
it really is. HMRC are very good at sending letters and reminders when you owe them, but when they owe you money,
it's a different
they're slow, to say the least.
Yeah. One thing I just want to ask you on as well, because I say it's a loaded question. It's not loaded in the sense of I'm trying to catch you out, but in terms of personal finance, and I remember one year about 7-8 years ago now, the one thing that caught me out once, which I learned from very quick, was payment on account.
Yeah.
And I learned that lesson very quickly.
Yes.
And make provisions. Do you want to just explain, because I could probably explain it, but there's no one better than you to explain it with us two here today. Can you explain how that could catch people out and what they can do to not be caught out by that? That's okay.
You're absolutely right. It catches loads of people out. So payment on account, we're talking about personal tax here. So you're going back to limited company, you draw a salary and dividends. That's personal income for you and declared on your personal tax return, and will create a personal tax bill. Let's say you've, between the two, the salary and the dividends, it's 50 grand a year that you've drawn.
Yeah.
That's going to create a tax bill of about £3,500. So one thing to mention is your personal tax year is different than your business.
Yeah.
So for you, me, and everybody else, it's the 5th of April. Yeah. So you draw a line in the sand at the 5th of April and say, how much personal income have I had? The following January, so at 5th of April, the following January, that tax is payable. Yep. So going back to our, let's call it £3,000. £3,000 tax payable in January. The taxman at that point, HMRC, will also say, I want a bit for next year as well. I'm going to assume that you're going to earn the same amount of money. So give me 1,500 quid. So you've got to find the 3 grand to cover last year's tax, the 5th of April, and you've got to pay an extra 1,500 quid to cover the year that you're in right now. And then the following July, you pay 1,500 quid again. So you've paid 3,000 on account by the time you hit 31st of July. And then you go through the process again. So if your income is exactly the same, then you will have paid your tax by end of July. And then back in the next January, you'll pay 1,500 again. If your income is more, so let's say you earn 100 grand, great. But you're going to have a catch-up payment.
Yeah.
So you've paid 3 grand, but your tax bill might be 10.
Yeah.
So now you've got to find an extra 7 to make good.
Yeah.
But then your payment on account kicks in again, which is going to be another 5. And that's a big hit. So it's the same thing again, Alan. You've got to plan for this as you go along.
Yeah.
You know it's going to happen. It's going to happen in January and July. You should be planning as you're taking the money.
Yeah.
And this is a big, I'm not going to say it's a mistake, but what a lot of business owners will do is they'll take money from their company and they'll spend it. And then when the tax bill's due, they'll have no money personally. Now remember, this is a personal tax bill. And they'll look around, I've got no money. So they'll look to the company, oh, you've got a bit of money. I'll have that, thank you very much.
I'll borrow it.
So the company's going to pay, going back to the first example, $4,500 to cover the tax bill. That $4,500 that the company's paid on your behalf needs to be covered by way of a dividend.
Yeah.
So if you're taking the 50 again, and then you've got $4,500 on top. So this starts to compound because that's going to create an even bigger tax bill next year. And especially if we look at you've earned 100,000 and that created I forget the numbers, up teen.
Yeah.
It was in the teens, wasn't it?
Yeah.
And then the company pays that. Your income is going into a scary rate of tax then. And you just end up in this cycle. So what I advise to do is when you take the money, I mentioned this to one of my colleagues and he likes it. I hear him use it on the phone all the time. When you take your dividends, there's tax in it.
Yeah.
There's tax in those dividends. So in your personal bank account, park a bit aside.
Right.
So if you take £1,000, park, I don't know, 150 quid aside. I do have a formula for all the different percentage points at different levels of income. But just get into that habit of when you take money, park a bit aside. If you think back to when you were employed, if you've been employed, you never got all your money.
No.
It was taken from you and passed over to HMRC.
Yeah.
So you've got to get in that mindset. HMRC gives you the luxury of paying later.
Yeah.
But you've got to have the discipline to be putting that money aside so that the money is there later. And just one other thing to mention on this point that gets people's backs up. Why am I paying HMRC in advance? It's not fair. Going back to my example, HMRC asked for this payment on account on the 31st of January. You're already 9-10 months into that financial year.
So it's not in advance.
It's not in advance. You've already earned the money.
Yeah.
It's just a payment on account, and then they ask for the rest in July and the rest the following January.
Yeah. So if you earn the same money year on year, because I think it's like you said, I think it's when your income goes up, you feel get really clever. But if you earn the same income next year, it doesn't feel as bad then, does it?
No, it doesn't. Because you get a nice routine. It's the 1,500. But it's when your income goes up, you'll get hit with that spike.
Yeah.
But also...
Is that when most people get caught, do you think?
Yeah, I think so. Because naturally, we all do it. You think, my tax bill last year was $3,000.
Yeah.
It'll be about $3,000 this year.
Yeah.
But, you may think, I've earned a bit more, it might be a bit more, but you won't actually know the figures.
Yeah.
And then that payment on account catches you out. But also have an eye on, because we're in January and we're always part way through that year.
Yeah.
If your income is lower in that year,
yeah,
you can opt to reduce that payment on account.
Right.
So where the taxman's saying, give me $7,000, for example, but you know your
income the coming year, but
correct.
But you're in advance, aren't you? Like you said before.
Yeah.
So
you can get the money back, reduce the payments on account. You've got options, but just keep an eye on where you are right now. Is your income going to be more or less in the?
I just thought I'd mention that because that's something that caught me out.
Yeah.
When I started making quite a bit more money, and I went, wow.
Yes.
I went out that year spending all sorts of money, still saving money, but then I've put money away in ISAs and property, and I probably overspent on investments and general spending.
Yeah.
Which, when you invest in property, it's illiquid as well. So especially when you just invest in the property, ISA's a bit different, but you don't want to take it out of an ISA because you can't put it back in.
You want the compound interest.
So anyway, that's cool. So, all right, cool. So I just want to go into sort of real stories and learning experiences, because on your LinkedIn, which you've linked to, you do some really good stories that resonate with me, and I think resonate with a lot of business owners, and I think it's worth everyone looking at that. So you've helped many clients turn their business around, and there's a story about a certain guy called Michael.
Yeah.
Whether that's his real name or not, we'll leave that to the imagination,
Yeah.
but I assume it's not. What are some of the biggest issues that you see that lead business to struggle financially?
Yeah. So if I think about Michael, let's say this is his real name. They were a two-person business,
right,
when I first met them, and in a bit of a mess. I had no idea they were actually making money or not. There was
they didn't have any idea.
They had no clue. And
why was that? I just want to.
Well, they used Xero, which I promote, accounting software, but they didn't know how to use it. And you'd look at it, and when I looked at it as well, it didn't make any sense. There was figures where there shouldn't be figures. There was minuses where there shouldn't be minuses. So they tried the best they could. And to their own admission, look, we're not accountants. We're not bookkeepers. Yeah. We give it our best go. So there was no visibility of whether they're making money or not. All they knew were the sales. And that's common for most business owners. They know what the sales are and they know what's in the bank right now.
Yeah.
But they don't know all the stuff in between.
Yeah.
And it's that accounting system that can give you that. So they just didn't know if they were making money. And I got involved and kind of tidied everything up, and they weren't making money. They weren't making enough money. They were drawing more money than they were making. So created overdrawn directors' loan accounts, created some, they couldn't pay their suppliers. We had some tax bills outstanding. And ultimately that business failed because they didn't know if they were making money, but they just kept plowing on and working harder, longer hours.
And why did it fail? Was it just a tax bill that came and they couldn't pay, or
combination of things? They weren't making enough money, profit. They weren't making enough profit. And then what tends to happen when a business owner doesn't make profit is cash is low naturally. So then you look, where can I get extra cash from? So you kind of got two other options. You've got investors or debt. Debt's the easier option. So you'll go to Funding Circle, kind of have some money, please. So, and that's what they did, or they'd done by the time I met them. And then you've got credit cards, and these are just plugging a gap. So going back to your comment before, turnover is turnover is vanity. I can't believe I forgot that.
Profit sanity. Cash is reality.
It is reality, but it's got to be good cash. It's got to be good cash, because anyone can go and borrow some money and go, oh great, we've got some money in our bank account now. Now we can spend it.
But when you're paying 12% a year and you're personally guaranteed the hilt,
exactly,
it's a problem.
It is a problem, and it was a problem for these guys. So ultimately, the business did fail. The partnership between these two chaps kind of failed, and they went their separate ways. Which was good for Michael, because with Michael, I kind of showed him it was the gross profit. So I always say to people, the most important number in your business is gross profit, not sales. So to clarify what gross profit is, it's your sales less your direct costs. So if you're selling desks, for example, you sell it for £1,000, it's cost you £500 to manufacture, your gross profit's 500 quid. So, and then we look at the percentage. So you take that £500 and divide that into your sales figure. Okay. So the higher that percentage, the better. You want as strong as gross profit as possible. They didn't. I think they were sub 20%. Below your gross profit, you've then got all your overheads, all your running costs, your rent, your accountancy fees, bank charges, insurance, the list goes on. And then there's nothing left at the bottom. There's no profit left. So when Michael started again, we looked at his business model and decided what you were doing before is not the best model. So they were offering like a complete solution, start to finish. Lots of moving parts in there. So we said, let's just simplify it. You're really good at this thing. You're really good at designing stuff. And people buy into that design. So there's a lot of value attached to that. So we said, why don't we just sell the design? Because it's just your time at this moment. And that's what we did. And it literally transformed the business in terms of profitability. And then obviously we were meeting monthly. So I could say to him, Michael, here's the profit, right? This bit needs to be moved aside for corporation tax. This bit needs to be moved for VAT. And this is what you've drawn. So this bit needs to be put aside for personal tax. So we had all these different pots in different places, but it just gave him clear visibility of, I know what my tax is going to be, and I know I've already got it covered, and I know what my profit is. And he's actually going great guns now. He's doubled the business since then as well.
Fantastic.
So it's great.
Is that with your help?
No, I'm not going to take all the credit.
No, but you've got to take some.
I think I've given him the confidence to make better decisions.
I think what you've done is just reading between the lines. Obviously, I think you said one thing: most business owners just look at sales and nothing in between. What you've done is you've translated what's in between, which is then equal, the bottom part, which is obviously the net profit. So you've obviously helped him. I don't know if you do management accounts, but you helped him understand basically everything down from, I'm assuming, from gross profit to your overheads, then to your net profit. I'm assuming you're that gap.
Yes.
And that's what's made him more profitable, and, him being able to pay tax bills and account for stuff. So you've just helped. If you think about it, if anyone's look up a general profit and loss account, but turnover, probably most small business owners understand the turnover side. Then the next part, cost of sales, they should really understand, but then the gross profit and the gross profit margins are really important, which they probably don't understand, a lot of them. And then obviously overheads, they can go out of hand if you don't have a budget in place. And that's one thing I just want to mention when we go to the next point. Setting a budget for the financial year for any business, I think, is really key. Even if you're starting a business, you need to have a business plan and a budget, which will then allow you to basically, what you should do in your management accounts. I'm assuming some of your clients do this, maybe some that don't, is you have an actuals versus budget,
Yeah.
and then you have a variance as well. And that's what we have across all our businesses. And
brilliant.
the variance is always in red.
Yeah.
Like, and then we know, okay, that's a big problem. And then you can have your variance for your total overheads and your gross profit. And for me, what you want is, I do green and red. I'm colorblind, by the way, so I struggle with this a little bit. But if everything's in green, we're good. If you notice anything in red at all, you need to investigate that with your accountant or your finance team at the end of the month and go, what's this? What's this? What's this?
Absolutely.
And that's made me a much better business owner and operator.
Definitely.
Going forward. So I'd say for anyone, it's easy when your accountant tells you this. Sometimes some business owners are sure, they just go, yeah, great, nice. And your accountant's meant to say that. I want to tell people that just so they understand that that is absolutely true. And I've not got that from purely myself. I've got that from finance people, who credible finance people like yourself. So I would actively tell everyone to get a budget in place for the business. It's so key.
I agree with that, and I think a lot of people could get on board with that if we kind of said, well, dare I say, we're coming up to that Christmas period.
Yeah.
A lot of people get a lot of time off. And during that period, kind of December, January, a lot of people set some goals and targets for the year.
Yeah.
And then it gets forgotten about probably about the 6th of February, something like that.
Yeah.
Well, if you revisit now those goals and targets and compare that to how you did, there could be a big gap. When you set those goals, you're all excited. You can't wait to get going for that new year. But like you said, when you set that target, that annual target is generally how people work. I want to make this per year or whatever it might be.
Yeah.
Chunk it down monthly. So then you can do exactly what you're saying. Well, to hit that target by the end of December, we need to do this in January and this in February. Did we hit it? Did we not? If not, let's make some adjustments.
Yeah.
Rather than let's review it at the end of the year after we've forgotten about it and see how we did.
Yeah.
And then set the same flipping target again.
No, absolutely.
You've got to chunk it down. And I think that goes for personal finances as well, Alan.
Yeah.
Set the budget for the personal stuff.
Absolutely. Maybe we can create a spreadsheet or something and put out there. I don't know. Maybe you put on one of your courses, but I think it's really key because you then need to know when you're going to retire, whether you're going down the pensions route, whether you're going down the ISAs route, whether you're doing a bit of everything. I don't know. There's lots of ways. Maybe in tax planning, we'll come on. I'm going to go to tax planning and management in a second, but maybe we'll come on to pensions very, very briefly.
Sure.
But just before we do move on to that, so for anyone that's listening that feels overwhelmed with debt or financial pressure in terms of the business, or maybe even personal finance with payment on account that we just mentioned. So just what simple, maybe one or two pieces of advice, what simple piece of advice would you give them? What do they need to do to get out of that, if that makes sense? What's the next steps?
First one I'd say is don't bury your head in the sand.
Yeah.
Don't bury your head in the sand. Realize that you've got a problem and ignoring it and just trying to work harder won't make it go away.
Yeah.
That's the first thing I'd say. And the second thing I'd say is speak to your accountant.
Yeah.
And if your accountant won't speak to you, get a different accountant.
Yeah.
And this is not a plug for people to come and work with me.
It is.
You've got to have a relationship with your accountant where you feel comfortable speaking and saying, I'm struggling. What can we do? How can you help?
Yeah.
And you've got to have that relationship. That's what your accountant's there for. They understand the numbers in your business. So that's my key advice, because I have worked with clients, and I still work with clients, unfortunately, where I'll have a conversation one year and we'll talk about a kind of a plan, an action plan.
Yeah.
And I have the same conversation next year and then next year. It's got to be reviewed regularly, and just ignoring it won't make it go away. Your numbers are your responsibility at the end of the day. It's your business. You can't just say, I'm not very good with numbers. My accountant sorts that. The amount of times I hear that.
Yeah.
My accountant sorts that.
Yeah.
I am the accountant. I have been the sorter of that. And it keeps me awake knowing that I've got to deliver the news to you the next day.
Yeah.
That you've got a tax bill that I know you cannot afford. And that could mean the end of your business. You could lose your house, all sorts of stuff.
Oh God, yeah.
Especially
like I think you mentioned the word the company funding circle, and I'm not going to. I'm not going to. Again, it's up to their business model, how they lend, and what they do, and is people agree to what terms as well. But with a lot of the loans of people I've spoken to, I think you've got to provide a personal guarantee a lot of the times. Yeah. So if you're providing a personal guarantee, for anyone that doesn't know what a personal guarantee is, if you're borrowing £200,000 from Funding Circle or any other bank or institution for that matter, and you personally guarantee it.
Yeah.
If your business goes under, you're going to owe that money. If there's not sufficient, liquidity in the business or profits in the business to pay that, they're going to come after you. So you need to be really, really careful, when you're entering into these sort of agreements and read the fine print, because, if you've got a house with a mortgage, or you've got equity, or you own your own house, whatever it is, every ounce of equity they're gonna come after. And if you've got kids and a family, your wife or your husband's not gonna be best pleased if you sign a PG without them knowing, and they come after you. Basically, you're gonna lose your house, you're gonna be renting, you have to live with a family. So, and the reason that I've got you on today, Karl, is I appreciate for a lot of people, tax and accountancy isn't as sexy, but if you don't get it right, then these are the situations you can come into. And again, I don't want to scaremonger too much, but it can happen, it does happen, it will happen again.
Oh yeah, well, I see it every day.
I bet you do.
Yeah,
in your role, so you've got to be really, really careful.
Yeah, absolutely.
So, and obviously this channel that I've set up is about investing in personal finance and growing businesses, and that's all well and good, but you can be the best person at growing a business, but if you can't manage your finances in that business, then you're going to have no business and you have no assets. So this is really key, all the stuff we're talking about.
I think often if the management of your finances is poor when you're small, when you get bigger, it just creates a bigger problem and a bigger mess, and those bigger loans.
Yeah.
And there's more risk involved there. If you're only doing a 100,000 turnover, then the risk is not as much. But if you're doing a few million quid, and you've still got those poor systems in place, then the upshot is that you could lose your house. And I've seen it. I've seen it before.
What I've learned, obviously, I've sold half the business a couple of years ago. There's two great fellas that work with, Mark and George, who are a little bit older than me, if you're watching this. A little bit older than me, but they're very wise heads. And what I would say to anyone is what I've learned more than anything from those guys. It's not the sales side of things, can do all that. It's having good tax planning, management, budget control, and making sure all your ducks are in a row.
Yeah.
And putting finance. And if you're not good at this sort of stuff, and I appreciate when you're small, a lot of small companies sort of go, oh well, I haven't got the money to spend on that. And we've had situations that we spoke about in the past with that, but I don't want to spend that much money. But the thing is, that could, if you're not making sufficient profits anyway, and you're not willing to spend on your tax or finance. I mean, we spend loads of money across our business now. You're probably going to come unstuck at some point anyway, if you're not good at that.
Yeah.
And typically, if you are, I don't want to stereotype it, but if you are more of a finance accounting type and you're starting a small business, on the flip side, you probably need someone who's good at driving sales.
Absolutely.
So what I would say is what you need to do is work out what you're good at. And if tax and finance planning is not what you're good at, you need to outsource that straight away.
Yeah.
Because A, even if you do it, you're not going to do it well. And B, you probably don't want to do it. I mean, for me, I understand numbers. I've got an economics-based degree, so I understand that, but doesn't mean I want to do it. I'm the best person.
Yeah.
So make sure that you delegate that out to the relevant team, whether that's an internal team or whether that's a really good accountant like yourself. So 100%.
Yeah.
One last thing on tax, just want to go through. Obviously, many different business owners take money out different ways, whether they take salary, dividends, expenses, directors' loans. It's quite a hard question. I want you to be very broad on this because obviously everyone's situation is differently, but in general, what in the UK, what is the most tax efficient way to take money out of your limited company?
Yep. So it has been and still is small salary kind of equal to your personal allowance threshold, i.e.
which is
the tax-free, 12,570.
Yeah, okay.
So that's the amount of money you can pull out your business completely tax-free, and the business gets a tax deduction on that as a cost. And then the remainder comes out as dividends because they're taxed on you at a cheaper rate, 8.75%, up to the first kind of 50K.
Yeah.
And then it switches to 33.75 thereafter. So that still is the most tax-efficient route of getting money, or as much money in your personal bank account as possible. Then there are other things like cars.
Yeah.
They're a big one. So, your mate down the golf club pulls up in his nice Range Rover and says, I get this through the business, and you jog onto the Range Rover thing, do the same yourself. And then you end up with a nasty tax bill because there are certain vehicles that are tax efficient and certain that are not. So a Range Rover, for example, is absolutely not, unfortunately, as nice as they are.
Unless you get a hybrid one, by the way.
True, yeah.
Which I've ordered.
Have you?
You get a hybrid one, yeah.
A few of my clients have gone for that.
Yeah, you get a hybrid P460E or something like that. If you order one of them, they're sport or the normal Range Rover, you can save quite a bit. I think the benefit in kind.
Is it 5%?
It is. I think it's going up next year to 6%. Yeah. You'll know more than me. But we're normally, I think what you're coming on to is a typical diesel petrol Range Rover is like, what, 30, 40%
Yes,
big, is it?
35, 37, something like that.
Yeah.
So what that means is that, number one, your company gets a very, very little tax deduction for this.
Yeah.
And then number two, you pay tax as an individual. This benefit in kind is extra tax that you pay. So if you're a high rate taxpayer, that's an extra 40% tax on I'll try and keep this simple. The list value of that car. So even if you bought a second-hand car, so a Range Rover, let's say you paid 50k for it, but its initial list price was 100k, that 37% is applied to the 100k.
Right.
And then you pay tax on that figure.
Yeah.
And your company pays national insurance on that as well, which was 13.8%, is going up to 50.
We're going to come for everyone on the budget, don't you worry. Yeah.
So you've got to be really careful with the cars.
Yeah.
If it's a van, fine, goes through the business. If it's new and electric, goes through the business, because the business gets 100% tax deduction.
If you finance it, not lease it.
Okay.
So we're going on something else here. Sorry, go on.
No, that's fine. That's fine, because these are we could talk all day about cars, I'm sure.
Yeah.
If you buy it, it sits as an asset on your balance sheet, and you get 100% deducted off your profits.
Yeah. So if it's 100 grand Porsche Taycan, for example, that's come off in year profits. Basically.
So if you made 100 grand profit, you bought the Taycan, you can buy it on HP, so you pay for it over the 3-5 years.
Yeah.
But that 100k comes off your profit, you'll pay no tax that year. The alternative is if you kind of an operating lease. It's like renting it, basically. Contract hire. So you've got contract hire for 3 years. That goes down as a bit of monthly cost, and that goes down in your profit and loss as a cost. So the amount you spend each year, that gets deducted against your profits and therefore reduces your tax bill. And the benefit in kind position is the same.
Yeah.
So on electric vehicles right now, that's only 2%. It's going up 3%, 4%, 5%.
Each year,
Hybrids, it depends.
Yeah, it depends on the emissions, doesn't it? And
it's the emissions and how far it can go on the electric charge.
Yeah.
So the Range Rovers are doing well.
Because it goes longer.
Because they go further.
60, 70 miles. So they said they're probably doing 40 miles, aren't they? But 60, 70 miles, I think it's quoted.
Yeah. I had a client that was looking at hybrids, struggling to find them, to be fair. Came to me with 2 options, very, very similar cars. I forget what they were. But one of them, the tax bill was $5,000 higher than the other one on the benefit in kind, because one would only do
personal tax bill, that is.
Yes.
Oh wow.
So one would only do 30 miles, and one would do 100 odd.
Wow.
So the percentage
changes between 5 and 10%, maybe.
I think it was 14. I think it goes up.
That's quite high. Yeah.
So hybrids, it depends.
Yeah. Speak to your accountant.
Yeah.
Yeah. Absolutely. No, cool. So essentially, to give brief intro what I do, normally pay the personal allowance. Obviously any profits we distribute to me and my business partners. That's the way I do it. Obviously, I've got cars for the business, typically electric at the minute, but going hybrid because of the new Range Rover hybrid's 5%.
Yeah. Where
I think at the minute as a recording now, I think it's 2% for electric cars. Yeah. But it's going up to 3% maybe next year, so it'll keep going up and up probably. So basically you can all that sort of stuff you can do. It's basically small salary, dividends, put an electric or hybrid car, but obviously speak to your accountant about it.
Yeah.
Anything else that you can do?
So we've got pensions as well.
Okay, yeah.
Not very sexy, but very tax efficient. Still very tax efficient. I know they've popped up in the budget. But this is your company paying into your personal pension. Your company gets a tax deduction on that. It sits as a cost in your profit and loss, and there's no tax charge on you in that pension.
Cool.
So that's a great way to get good money out. So typically is that
100% deductible? So if you put so you put 30 grand as your pension from your business can pay it straight in, yeah. So you pay it straight in 30k. That comes off your profit and loss account straight away. That's paid into your pension. So you're basically, it depends on what tax rate you're paying, whether it's 19 or 25% your corp tax. You're saving that.
Correct.
On your bill anyway.
Yeah.
You're not paying it personally, so you're not having to take a dividend to pay into your pension.
Correct. Yeah.
And so that's a really good tax deduction potentially as well.
Yeah, that's good. Other smaller things, you've got something called relevant life insurance. So if you pay life insurance, most people do. Most people pay it personally.
Yeah.
So you're pulling money out of the business, you're getting hit with that tax on your dividends,
and
then you're paying with the net that's left over. You can actually pay it out of your business if it's a relevant life policy, specific policy written by some tax nerds that gets through the company. So it's a company expense, reducing your company tax bill and not impacting your personal liability. The figures are small, but every little helps.
Absolutely.
And the other one, which people like, is the trivial benefits. So this is aimed at employees, but can be used by directors, i.e. your own business. So it's a kind of gift of up to £50.
Yeah.
Okay. Can't be performance related. I always use Amazon vouchers because everyone knows Amazon. If you gave an employee a £50 Amazon voucher just because it's their birthday, for example.
Yeah.
Okay. So that's not taxable on the employee and it's tax deductible for the company. As a director business owner, you can do that yourself 6 times throughout the year.
Cool.
So it gets load up the Amazon account before Christmas for the kiddies' presents and stuff like that.
That's very good. I didn't know about that one, so I'm going to make a mental
Really?
note
There
of
you
that.
go.
No, brilliant. All right, so I just want to go into business profitability and financial controls, which we've covered slightly, but I just want to cover a bit more detail. So in your post on LinkedIn, when I spoke to you, emphasised that profit doesn't come from just working harder or selling more. So what practical steps, can business owners take to improve profitability in their business?
It's going back to what you said before, Alan. You've got to look at it. You've got to look at your numbers. You've got to know what you're currently making now. Looking at the bank account won't cut it. So you're looking at your top line sales, cost of sales, gross profit, and then your overheads below.
Yeah.
Think of each of those as like a lever.
Yeah.
So sales, we can make sales go up by getting better at marketing, converting more leads into clients. But we don't want to do that by sacrificing gross profit, i.e. offering discounts.
Yeah.
The amount of accounts that I've seen where the client, speaking to the client throughout the year, we're dead busy, sales are growing. You pull up the accounts at the end of the year, sales have grown, sometimes doubled, but they're less profitable because they've sacrificed that gross profit.
Yeah.
So be really diligent with your model and your gross profit.
Okay.
Stick to your guns. Don't throw money away.
No.
I guess is what I'm saying.
And I suppose the two key metrics there's more, but the two key metrics I'm thinking about now, what I look at is gross profit margin and net profit margin.
Yeah, absolutely.
And I mean, for everyone that doesn't know, obviously, your gross profit margin is essentially your cost of sales divided by your turnover, your sales and your business, times by 100 equals that. So, if you've got, if your sales are 100 quid and your cost sales are 50 quid, then 50 divided by 100 is 50%. So, and net profit margin, essentially is the same, but it's like different metric, which we can go into. But what typically are good, again, I know it varies across industries. I know like construction can be really low, for example, and I know software business can be really high in terms of these margins. But when you're looking at someone's general accounts, what are good margins to look at when you start a general business in terms of your net profit margin, your gross profit margin?
So I'll start with the net profit because that's easier.
Yeah.
You want to be looking at least 20%, really.
Yeah.
Okay. As you grow your business and get bigger, that might slip down to 10%, which should still generate good profits because the top line sales are higher, but you should be at least looking for 20%.
Sure.
The gross profit, as you said, is difficult, and the typical accountant's answer is it depends. Depends on your business and your industry. Anything above 50% is going to be good.
As a net profit margin.
As a gross profit margin,
right.
As a gross profit margin. Anything above 50% is going to be good. If you're below 20%, it's difficult, okay?
Yeah.
Because you've got to compensate for that low margin by constantly bringing in more sales.
Big volume, really, isn't it?
Yeah, exactly. So if you think about going back to these levers, you've got your gross profit here. If that's only 20%, then you've got your overheads below that.
Yeah.
That 20%'s got to pay for the marketing budget, the
staff costs,
motor costs, everything that goes into running a business. And what you'll typically find is because it's a low margin, you need more sales. To get more sales, you need a bigger marketing budget.
Yeah, sure.
And then when you get more sales, you need more admin staff. You need a bigger office. So the overheads just keep swelling. And it's a case of where do you stop?
Yeah.
So I often refer to businesses as being in no man's land. You've got to know what you are and where you're going.
Yeah.
A business going on its way up to kind of £1 million can produce some nice profits.
Right.
Then when you go into that next level of growth, that's where you've got to reinvest in maybe a second level of management, HR, that kind of thing.
Yeah.
That's where your overheads start to swell. And you'll notice there'll probably be a dip in profitability at that point.
Sure.
And it's knowing at which point you're going to come out the other side.
Yeah.
So I often see businesses between maybe 1 and 2 million and then going up to 5 million. That's a difficult place to be.
Right.
So you've got to know, do I want a lifestyle business that's earning me £250,000 net profit a year?
Yeah.
Which you could do off a £1 million sales.
Absolutely.
Or do you want a huge monster business that's doing 10 million sales a year that you could sell for £10 million one day?
Yeah.
I think knowing where you're going is crucial because I think if you speak to a lot of business owners, you'll say, what's the drive for this year? Oh, we're looking for growth.
Yeah.
What does that mean? Growth in what? And it should be growth of net profit, free time, that type of thing. But just growth in top line can often lead to lower profits, actually, Alan. So I don't know if I've answered your question, but the Gross profit margin, it's crucial to know what it is and what it should be.
Right.
Okay, so if you're selling something, let's go back to this desk, we said 50% gross profit, didn't we? If you looked at your accounts at the end of the year and it shows a 30% gross profit, you need to know why.
Yeah.
What's gone wrong?
You're either discounting you're going to be discounting too much, aren't you? Your competitive market where maybe it's not, financially viable if you're competing against China selling them, for example.
Yeah. And also there's a difference between gross profit and markup.
Yeah.
So you buy your desk and then you mark it up by 50%.
Yeah, sure.
That won't deliver a 50% gross profit.
Of course.
It's a lower figure.
Yeah.
So just being aware of those two, so many people get caught out by that.
I can imagine.
Yeah.
And just again, from your LinkedIn, you've got your monthly finance checklist that helps keep businesses on track. I'm asking you to walk through all of it because people can go and have a look at themselves, but what are the key tasks on there that people...
It's the things that we've discussed really, Alan. So it's reviewing your numbers. Yeah. It's every month. It's looking at your profit and loss.
Yeah.
You look at your balance sheet. You look at your cash flow. You look at any key metrics you've got there. Who owes you money? Who do you owe money to?
Yeah.
You're looking at an estimate of tax, of VAT.
Yeah.
Corporation tax, VAT, personal tax. And you're saying, have I got enough money to move that aside?
Yeah.
You've got to look at that, and you're looking at what have you drawn as a business owner? Could the business afford you this month?
Absolutely. Those
types of things. It's just getting to that habit and that routine to say, is my business profitable? Does it have enough money? Am I filling the holes before I'm growing?
Yes.
I think is what I'm getting at.
Yes.
The leaky bucket analogy, if you've got holes in your bucket and you pour water in, if you just pour more water in, you just get more water coming out.
Absolutely.
If you start to kind of fill those holes, fill the gaps, for example, I have a newsletter, as you know, Alan, and on that, when people sign up to the newsletter, I ask them what's the biggest struggle in relation to your finances. I would say 50% put one word.
Yeah.
And that word is cash flow.
Right.
And if it's cash flow, that is the consequence. So you're not getting enough money coming in.
Sure.
Where are the holes? You've got to look to find those holes. Are we making enough profit? Are our customers keeping too much of our money? Are you paying us late?
Yeah.
Are we paying our suppliers too quick? Do we have too much debt with high interest? Am I taking too much money from the business? Yeah. Are we spending too much money on this? You've got to look for the problems and fix that, which will then in turn, help that cash flow issue.
Yeah, no, absolutely. No, it's really good. So what I want to move on to now is the impact of the UK budget on businesses very quickly. So we've discussed it prior actually, but looking at the latest UK budget, what are some of the key changes that that could really affect small business owners? I think I know the one you're going to mention first. Yeah. So yeah. I'll let you crack on because you've done your analysis.
So the one is the rise of national insurance, employers' national insurance.
Just people that understand what is that.
So when you hire somebody,
yeah,
let's say you've got a headline salary of 30 grand a year, the cost to you as a business owner is not 30 grand a year for employing that person. There's a threshold, which currently still is, £9,100. So that first 9,100 of the 30, there's no extra cost. But after that, you as a business pay an extra 13.8%.
Yeah.
Okay. That has been increased to 15%.
Yeah.
Okay. So 1.2% increase. You might think, oh, well, not so bad. What they've also done is reduce the 9,100, the free bit, down to 5,000.
Yeah.
So it kicks in sooner when you start paying that employer's national insurance. Now that sounds bad and scary and everyone's going to be running around, as they have been doing on LinkedIn, saying everyone's business is doomed. It's not. For many small businesses, you may even be better off.
Right.
Because there is also something called the employment allowance.
Yeah.
So where we are today, that is £5,000.
Yeah.
Which means the first £5,000 of employer's national insurance is free for you.
Right.
Okay, so you get a discount of first £5,000. Yeah. That's being increased to 10,500.
Okay.
So for many small businesses, I'm still working on my calculator, you're actually better off because the 10,500 is greater than the increase.
Right.
So you're no worse off and often you're better off. I think definitely if you got up to 5 employees, you're better off.
Okay.
I can't remember the numbers off the top of my head. And it depends on The businesses that are at risk of having a bigger increase are obviously those with higher payrolls.
Yeah.
As your business gets bigger and you've got higher payroll costs, it will cost you more money.
Okay.
But it also depends on how much you're paying, your average salary for each employee.
Yeah.
So if you've got a £200,000 payroll bill, but you've only got 5 employees, that will look very different than if you've got £200,000 with 10 employees, for example. It will cost you more if you've got more employees.
Yeah.
And that's also compounded with the rise in national minimum wage as well.
Cool.
So I'm thinking of people like restaurants and that pay a lot of people maybe national minimum wage. There's a lot of employees. People like that are going to be hit harder than those people maybe where they're paying a handful of employees 50, 60, 70,000 pound a year.
Yeah. No, it's a really good analysis. So that was definitely the main one for me, going from 13.8 to 15%, which I noticed straight away. And I went, wow. I think for me is, again, we're not getting party political because I don't think the last one did a great job either. But if you're trying to grow your economy, you've got a growth budget. I think for the majority of businesses, if you're going to increase the national insurance contributions, and again, I understand why they've done it to raise taxes, because I don't think you can really get away from that one.
Nope.
So there's not, you
have to take it from somewhere.
You can't get away from that one, and you're going to take it. That being said, though, if you're trying to grow your economy, I think all that's going to do is maybe push on unemployment up slightly, because you're going to get people who are going to either offshore. Yeah. You don't have to pay national insurance contributions if you go offshore, and people are going to be thinking about giving pay rises. So you might see a deceleration in wage growth, and you might think, well, that person I was going to take on, I might not take on. So it depends. If it was a growth budget, I think it was completely wrong. If it's just a tax grab budget, which I suspect it is, to be honest with you, then it's probably the right thing for them to do. But yeah, I'm not so sure. Is there anything else? I mean, that was the main one for me. Is there anything else that stood out to you?
The bigger one for business owners is the capital gains side of things.
Yeah.
So selling your business, we're talking about here. So most people, they'll probably still call it entrepreneur's relief.
That's what I've been through that. So yeah, that's why. Is it business asset disposal relief?
That's it.
Yeah,
Thank you.
Yeah.
Or BADA, I think they call it. Yeah.
Whatever,
so anyway, right now, actually not right now. Yes, it is so. It's still right now. If you sell your business, you'll pay 10% tax on the first £1 million.
Quid, yeah.
And then it was 20% thereafter. So a couple of bits to unpack there. The main rate of corporation capital gains tax, has increased from 10% to 18%.
Right.
And the higher rate has gone from 20% to 24%.
Yes.
Okay. And that kicks in straight away, 30th of October. But for us business owners, the 10% is still in play until the 5th of April.
Right.
Okay. So you sell your business between now and the 5th of April, you'll still only pay the 10% on the first £1 million, and then it'll be 18%.
Oh, so that first million's going up from 10 to 8. It's going up from 10 to 18, is it basically?
It will do.
Wow.
It goes up, so it's staggered. So from the 5th of April next year, it goes to 14.
Right.
And then goes to 18 the following year.
All right, okay.
So in 2 years' time, any business owner selling the business will be paying 18% tax.
On the first million.
On the first
and
million.
then after the first million, it's 24.
Yeah, nailed it. Yeah.
Wow.
Yeah. So that's big.
That is massive.
That's a big difference when you're looking at selling your business for your big payday, as it were.
Yeah, it'd be interesting to see. And from M&As watching this, will that affect people selling the businesses?
I think people will be accelerating their decision.
They'll be accelerating trying to sell them. I'm saying after the period when they think about selling the business, is it, is that going to affect it or not? Are people going to decide to if they're going to sell?
Maybe.
Did they do a move to Dubai? Did they do a move to Dubai and sell from there? I think you're going to see a hell of a lot of that.
Yeah.
And it'd be interesting to see whether we ever see the figures, what the revenue figures look like on that. I think that might slow down businesses selling.
Yeah.
Because people might go, well, if I've got an EBITDA of 3 times and I'm going to sell it and get taxed, do I just keep on churning profit and put a manager in? That's what I'd be thinking anyway.
Yeah.
If you're going to get a ridiculous amount of money, 7, 8, 9, 10, 12 times, these software businesses going for all sorts of money at the minute. They might sell anyway, but then they might move abroad when they sell, which I'm sure is an option maybe, if you go and base out of different tax residency. It's going to be interesting to see how that goes. But I think what it says to me is that if you're a business owner, then this government's coming in, they want to tax you more heavily, which, is that going to reward you? Is it going to, are we going to see the productivity and the entrepreneurial spirit in the UK? And that is yet to be seen. Who knows?
Yeah.
We will see on that, but
it feels harsh, doesn't it? Because as business owners, we take the risk.
Yeah, absolutely. Yeah.
We take the risk, and we've got the entrepreneurial spirit, and you look at this stuff and think, what's the point? But I think for most entrepreneurs, it's just in you.
Yeah,
to
absolutely.
be an entrepreneur. So I don't think it may deter some people. People go, do you know what? What's the point? I'm going to go and get a job. I think if you've been an entrepreneur, it's very, very difficult to then go and get a job. So I think it's what we've got. It's where we are. No point complaining about it.
No.
What can we do about it?
I think for me, anyone's watching this, look and sell a business, I would want to be maximizing my sort of valuation on my business that I get for me to sell. I just think if you've got if you're going to sell it 2 or 3 times now, and your business is worth under $1 million, or the shares in your business are, it would definitely, just personally speaking, it would definitely make me think, well, that's gone from 10 to 18%. Yes, okay. 8% on £1 million is what? It's an extra 80 grand, isn't it? I don't know. Everyone's different, aren't they? I just know it would make me think I need to have a maximised value in my business before I get out, or I'd look maybe not to sell. I don't know, but I think it definitely changed the ball game for me.
I think it would. I think it's a good point though, that in terms of, you should always build your business to sell anyway.
100%, yeah.
Or whether you're going to sell it or not.
Yeah.
Because you've got the choice then, haven't you? You can sell it and get your big payday.
Yeah.
And like you said, that decision may become a little bit tougher, and it may lean more towards, well, I'm out with the business. I've got a business that generates profit, provides me with a good lifestyle. Why would I want to mess that up?
Just want to ask one question. I've not actually put this on my notes, but it's just come to my head really. I suppose a lot of it comes back to tax actually. I suppose the impact of the UK budget. I was having dinner with a friend last night, and he was speaking about different tax havens. You see a lot of these people now saying, go and base a company in Cyprus, or, go and base a company in Dubai. Just talk to me. I think I know the answer, but I want to hear it from you. Just talk to me about a lot of these people that are saying that. And again, you're not going to be an expert in those tax regimes. I understand that. But people who think, I'm going to go base a company in Dubai, and let's say you've got an Amazon business and you're thinking, well, I can base it in Dubai. My interpretation is really, personal tax wise, it won't make a difference, but from a corporation tax, would it? And can you even do it?
You got to live there.
Yeah, okay. That's the key.
That's my understanding. Yeah. Anyway, like you said, I'm not an expert in Dubai, but I believe if you want to go and set up a business in Dubai and pay no tax, I think there are different areas in Dubai.
Yeah, you've got like business-free zones and all that.
Yeah. My understanding is you've actually got to go and live there to benefit from that. Yeah. You can't, because otherwise, I'd do it.
Yeah.
We'd all bloody do it, wouldn't we? We'd all say, well, let's just carry on as we are. Let's just go and incorporate a business over there. We'll run it from here, and then we'll benefit.
Where you go?
Yeah, it's not that easy, unfortunately. I think you've got to go and live there.
Yeah, you see a lot of stuff like Instagram now going, Cyprus is low taxes, but you've literally got to live there.
I get lots of phone calls, Alan. People who book in for calls with me, and it's a case of, I see you talk about tax, Karl, and saving tax. I want to go set up in Dubai. Oh, right. Are you going to go and live there? No. I just want the free tax. Yeah, it doesn't work. It doesn't work. I've had quite a few of those phone calls.
Yeah, just
over the last couple of years.
Yeah. No, cool. So last one then on, I think this brings us nicely on to building financial confidence. So how can small business owners develop a healthier relationship with their finances and avoid viewing it? And I know you've gone through this, but I just want to clarify it for everyone, and avoid using the business as a cash machine. So if you had to give one tip before we're finishing off, what would you say?
I think I'd probably say, realize it's your responsibility. It's your business, and they're your numbers. Yeah. So it's your responsibility to at least pay a little bit of interest. I'm not saying you have to become an expert and learn how to become a bookkeeper, a financial analyst. I'm not saying that. But what I'm saying is, you should be paying attention throughout the year. Yeah. Not just once a year when the accountant delivers you that tax bill. Take responsibility for your numbers. It's your business. The numbers tell the story. So if you can learn to understand that, like you've shown that you've done, Alan, then you can make better decisions that will improve your business, mitigate risk, avoid losses. It's not just something that your accountant does for you. It's your business and your numbers.
I've always viewed it as, I don't view the business as a personal cash machine, but what the business does, the business should work for you. But for the business to work for you in the correct way, you need to be making sure that all your business finances, and again, this is where you come in, mastering your business finances, make sure that's all done. And then what you can do is you can make sure it works for you and that it can act as a cash machine, but in a way where you're not going to get taxed the hill or you're going to get in trouble with HMRC and not be able to pay.
Absolutely.
So I do view it as a cash machine. The businesses are working,
It should be.
But not as a personal cash machine where, I'm putting through all sorts that it's not tax deductible and I can't get back. But that's having the right setup and the right people around you.
Exactly. It's having a business that works for you, like you just said.
Yeah.
It's a vehicle to give you the life that you want.
Yeah.
So you got to reverse engineer that process. What does that look like? What does your personal life look like? And therefore, what does your business need to do to achieve that for you? And just having some discipline and some structured habits how are we tracking?
Yeah.
Is that business doing what it should be doing to give me the life that I need?
Yeah.
And that comes back to, it's not just money, is it? It's time. For me, I don't know about you, Alan, you're younger than me, I think. But
yeah, slightly. Yeah.
The minute I crossed 40, it was like my head changed.
Yeah.
I started thinking about retirement more than anything and spending time with the family. And it's weird that the priorities change from money to time.
Yeah.
And free time and quality time. And I think for me, that's a big factor. And I speak to a lot of clients at the same point.
Yeah, for me, time's finite, but money's infinite.
Yeah.
And you can always create more money if you need to, but you definitely can't create more time.
Absolutely, yeah.
It's quite deep, isn't it? But it's true. And I think, I've always been on the case of time over money.
Yeah.
And I've learned over the past few years from running businesses and, and again, listen, there'll be a lot of people watching this who have got a lot more money than me, don't get me wrong, but it's about having, it's about finding how much you need, but then how much time you need. Do you want to go and watch kids at sports days, or do you want to be stuck in a corporate entity where you're stuck in Copenhagen because you're in a business meeting, or time over money for me.
Yeah.
Again, time is finite, money is infinite.
Yeah,
and
stealing that.
Absolutely. I've just made it up on the spot as well, to be fair. So, okay, I think we'll wrap it up there. So for anyone to find you, you've got two parts to you, haven't you? So you've got the accounting business, and you've obviously got the personal finance course. So can you just talk through that very quickly, and then we'll wrap it up?
Yeah. So I've got a typical accountancy business, and currently there's no plans for that to become a monster business. There's 12 of us. It runs very well, and we provide a good service to the clients. And I'm almost scared to sacrifice that, Alan. So what I did last year, I created a digital on-demand video-based course called Mastering Company Finances that teaches business owners how to master their company finances.
Which is what we talked about today.
It's everything that we've been through today, and it's an on-demand course that you can go and just sit through at your leisure. Most people kind of will do like a video a day or something like that. Yeah, and it's got lots of tools and templates that you can download and literally plug and play for your business. So things like planning for those taxes, the corporate, the personal, understanding what your profit and loss should look like, all that type of stuff is in there.
You recommend that for all business owners who are starting out, maybe struggle with the finances. And I think again, for me, reading your own posts, and again, we'll link to all this. It's well worth looking at your posts and definitely watching this video as well, because I think you'll get a snippet into what you're offering, not just as a forward-thinking accountant, as your LinkedIn says, but also what people can do and sort of the courses they can look at and how they can start mastering the business finances today. Which I think if you want to make more profit in your business, like I said, management accounts, budget, but also this sort of stuff is absolutely key, and it will get you on the way, to becoming a better business. I was going to say better business owner, but a better business operator.
I think so. I think I always come back to three words: clarity, confidence, and control. That's kind of what I sum up the course gives you. When you got clarity, you understand what's happening. Yeah. You got control because you know where your money is and you know what your profit is. And that then gives you confidence to kind of say, I know where my business is. Now I know how to grow it. The amount of people that say to me, I'm too scared to spend my money. They can see the money in the business. Sure. They're scared to spend it because they don't know what is owed to HMRC. They don't know how much of it actually belongs to them. And the course kind of gives you that roadmap, as it were, to go and find out.
Bro, I think we'll wrap it up there. Karl, thank you very much. Thanks, it was very interesting. I hope we've made tax and business finances and mastering them very, very sexy today. As always, everyone, please like and subscribe to the channel. There's lots of content on business finances, investments, entrepreneurship, which you can look at as well. But without that, without all this from Karl today, that means nothing. So make sure you get your business finance in order. Follow Karl on LinkedIn. I will, link to the show notes to that. And Karl, thank you very much. Thanks, and Alan. I'll see you again soon.
Yep. Thanks for having me.
Cheers. Bye-bye.
Cheers. Bye.